Yeah, Tyler, we really, as investors, we're at the mercy of management and the board, and you hope that they have great grounding because there is no corporate governance. The existence of the independent director is a myth. What the independent director is qualified by what the exchanges say constitutes independent director, not the SEC, the exchanges. So if you're the New York Stock Exchange and you're competing with NASDAQ for a listing, you're not putting onerous requirements on the board. You're saying, I want to make it as easy as possible to get them on here. Let me give you a couple of examples. Martin Franklin's been on the network numerous times when he ran Jarden. Jarden was acquired by Newell. A shareholder sued, not the institutions, just a hedge fund. And what the court found, and none of this is hyperbole, none of this is fiction, this is all in the court record. What the court found was that the independent director was Martin Franklin's closest friend for 30 years. CEOs pick the directors. Now, when it went to court, the court ruled on behalf of the company. The merger price was about $59 a share. The court, the Delaware court, said to the shareholder, basically, we're punishing you. For bringing this lawsuit, we're awarding you $47 a share. And then you know what they did? The judge imputed an average merger price to Martin Franklin and the CEO and the president, averaging $74 a share. Why did he do that? Because the deal closed in 2016. There were options, RSAs, which are restricted stock awards, that were coming due in 2017, 2018. And in those RSAs was another $180 million to Martin Franklin and $72 million to each of those two other individuals. What the court found is that the board did not even go through those employment agreements. And in fact, it was likely that Martin Franklin and his two cronies were not entitled to them. So he said, I'm adding that to the merger price. I'm also adding the corporate jet, which the board sold to you for half price. Yeah. That money could have gone to shareholders. And I'm adding the office you had in Aspen and the office you had in Boca, because you got those at a discount.
It's Kelly
That's
here.
one example. There are many.
Exactly. And you talk about a few. Yeah. I mean, some of them are Chinese companies. You talk about HP's acquisition of Aruba. You know, and a lot of these issues.
Chinese companies.
Yeah. You say that Microsoft and NVIDIA might be companies that actually have good corporate governance, but that ultimately this is something that the SEC needs to define. Do you really think that they might go into this area? And if they don't, what happens? So for all the ESG money out there, do you basically think people who are doing this under the guise of the G part of it, they want companies with good governance, you know, do you think that that doesn't really stand up to scrutiny until or unless there's some kind of bigger SEC definition that they can comply with?
Look, I met with the SEC in D.C. a couple of times, had breakfast with one of the commissioners under the Trump administration. It was a Democrat in New York. They're not doing it. They can't even handle insider trading. They're just understaffed. I'll give you an example, okay? The commissioner I met with told me that he looked at data of all the insider trading in advance of a takeover, and he found 801 instances of it, put it up on his website, and that sent it to the SEC. They went through one of them. You take a company, and this is Instructure, which is coming public. Instructure, hedge funds got the stock up to 54 right before the takeout. On December 1st of 2019, the then CEO sold stock at 54. The deal was announced at 47 3 days later. He knew a deal was going to happen at that price, but yet he sold. I can give you other instances where board members did the same thing in that 5-day window when the deal's agreed to and before it gets announced.
Shepard Smith here. Thanks for watching CNBC on YouTube.